Hello and welcome back to the Note. Well, today was the first day of ECB QE. The European Central Bank is buying bonds today, and it's been a relatively muted response so far from the markets. There is a ripple of new concern about Greece in Europe, with renewed brinkmanship happening, even though there's a few more months before the next deadline there. Oil has fallen a little bit today. It's now back down towards the lower end of its recent range. And here in the US, you've seen a partial reversal of the dramatic day we had on Friday. Bond yields have come down a bit. Stocks have come back up a bit. The central question remains European bonds. Why exactly are they negative for several of the biggest countries? Is this because the central bank is intervening, or is it a rational market response to deflation? Now, Paul Jackson of Source has offered me some very interesting historic evidence that it's down to the central bank. What we're taking a look at here is historic data for Dutch bond yields, which go back to the 1500s. And you can see over that entire period, this is the first time they have ever gone negative. Meanwhile, if you look at Dutch inflation data, you can see that we've had deflation many times in the past, that the current level of inflation is really in the middle of the historical range. Mr. Jackson's argument, and I find it hard to fault his logic, is that therefore, now that we're in the unprecedented situation that people are prepared to pay the Dutch government to look after their money, this must have something to do with central banks, not with deflation. If that's true, then obviously you should be rather worried about buying a bond at a negative yield. It implies there could be really quite a serious loss to be made once the central bank removes itself. But I suppose against that, it does look as though the ECB is going to be buying bonds for a long time. Either way, it's a strange and rather worrying situation.